The reason all crypto was down Monday, some triggers forced liquidation in Ether, thereby bringing down the entire space. And this clearly has the potential to create inordinate amounts of volatility and chaos that can be vicious, like it just did on Monday. We are in the midst of perhaps the biggest tech revolution of them all. The opportunities are huge, and so are the pitfalls. And I want to summarize the issues so you can more fully understand what's going on and what are the opportunities and where are the risks. Hi, this is Steve Eisman, and welcome to another edition of the Weekly Wrap. This is for the week ending September 26th, 2025. This week, I am offering a sneak peek because I interviewed Andrew Sorkin of CNBC about his new and soon-to-be published book titled 1929. It's all about the crash of 1929. Now, why do we care? After all, they're all dead. But what's old is new again. And the book describes the completely unregulated nature of financial markets and the resulting shenanigans. Sound familiar? The manipulations and crazy-ass leverage that occurred back then were fundamental in creating the 1929 crash. Because of Sorkin's insights and the parallels to today, I'm labeling today's conversation Shenanigans, Chaos, and Revolutions. If history often rhymes, I say it often rhymes too often. Shenanigans first occurred on Monday, when there was a large crypto sell-off with some cryptocurrencies down 10%, and that was without any news. The huge sell-off Monday reveals the Wild West nature of crypto. Why the sell-off, you ask? Good question. Because much of crypto trading occurs overseas. So what, you ask? Because approximately 40% plus of the global crypto spot market trading volume occurs on Binance, an overseas trading company. Binance is several times bigger than Coinbase in terms of trading. Fun fact number one, Binance was originally located in China. Fun fact number two, it then relocated to Japan. Fun fact number three, it then moved to Malta, and now Binance is located in the Cayman Islands. I call all those fun facts a big bunch of red flags. Like 1929 and stocks back then, regulation of crypto today is still in its infancy. The big difference today is that we live and trade in a global village. The companies located here in the United States are at something of a disadvantage. They occupy the high ground in that the US-based companies severely restrict how much leverage traders can employ when trading crypto. Binance, from its current home in the Cayman Islands, has no such restrictions. Binance allows leverage. How much? No one really knows. But some people think it is considerable, and much of that leverage is given to Binance's Asian trader clients. So back to Monday's sell-off. The reason all crypto was down Monday was that apparently some triggers forced liquidation in Ether, thereby bringing down the entire space. Because of the leverage that entities like Binance allow, these triggers force immediate liquidations, and then a rapid de-risking across the space occurred. So the risk in cryptocurrencies is not necessarily in Bitcoin or Ether, it's that the largest exchange is Binance, which, as I said, is located in the Cayman Islands. Red flag again. Binance provides an unknown but apparently large amount of leverage outside the US to its customers, and this clearly has the potential to create inordinate amounts of volatility and chaos that can be vicious, like it just did on Monday. So what's the lesson here? Why do we care? Because the risks in crypto are not necessarily in the asset class itself, but with some of the players like Binance. And if we look at stablecoins, the risk for the owners of Circle stock is in Tether, the largest creator of stablecoins, which is based in, wait for it, El Salvador. Red flag. Tether invests parts of its stablecoin assets in alternative investments. Another red flag. So the risk to stablecoins as an asset class is that one day Tether announces that its stablecoin has become unstable. High volatility hinders cryptocurrencies from becoming part of the global payment system. That's why the only digital currency that can accomplish real presence in global payments is stablecoins. Stablecoins' valuation is always supposed to be par, but the unregulated nature of Tether has the potential to destabilize its own stablecoin. And this has tentacles for companies that are US regulated, like Circle. Now, before we turn from shenanigans and chaos, let's talk about the market. The market feels tired to me, despite the fact that it is hovering near new highs. Now, how do I know it's tired? Less than 60% of the S&P 500 is above their 50-day moving average. That's a technical term, but what it really means, in other words, is that the market has become more and more narrow. And this trend is not healthy in the long term. Maybe what is happening is that the market is consolidating and treading water until the next move. But it does feel tired. When I look at my screen on up days, there is a lot of red. Now let's turn to revolution, specifically the AI revolution. We are in the midst of perhaps the biggest tech revolution of them all. The opportunities are huge, and so are the pitfalls. And I want to summarize the issues so you can more fully understand what's going on and what are the opportunities and where are the risks. By my count, since 1960, there have been 5 and now 6 major tech innovation revolution waves. The first, 1960 to 1975, was the mainframe revolution led by IBM. The second was 1980 to 1990, the invention and proliferation of the personal computer led by Microsoft, Intel, and others. The third was 1990 to 2000, which was, of course, the creation of the internet, the networking revolution, and the growth in cellular led by Cisco and T-Mobile. The fourth, 2000 to 2010, online retail, social media, and search, which is, of course, Amazon, Meta, and Google. And the fifth, 2010 to 2020, was the explosion in mobile internet, migration to the cloud, and software as SaaS model. And now we are in the sixth revolution, AI. Now, each wave has sparked periods of enormous CapEx, productivity gains, and huge spurs to GDP growth. And this is what makes investing in the US unique. The winners from one wave are often not the winners in a subsequent wave. Start in the year 2000 and go in 5-year increments and look at the top 25 names in terms of market cap for tech stocks in those 5-year increments. And you find something amazing. Mel Brooks would say, it's good to be the king. But I say, it's hard to remain king. Usually, something like 20 to 25% of the top 25 changes every 5 years or so. And once a company drops out of the top 25, it is unusual for it to bounce back. The demise of Intel is an extreme example, once a tech leader and now barely surviving. Here are a few other names that appeared in the top 25 in 2015 and 2020, but are no longer there. eBay, Accenture, Hewlett-Packard, Qualcomm, Texas Instruments, Booking Holdings, Tata Consultancy, and Baidu. Interestingly, despite all the hype and movement in the payment space, and there has been a lot of movement in the payment space, both Visa and MasterCard remain consistently in the top 25. Let's look quickly at the Mag 7 and a few other AI-related stocks to see how they have done so far this year. Google up 28%, Meta up 29%, Nvidia up 30%, Apple up only 1%, Tesla up 6%, but it was down quite a bit earlier in the year, Amazon flat, Microsoft up 21%, and Broadcom up 44%. Oracle up 77%. Palantir up 133%. GE Vernova up 85%. Arista Networks up 27%. Cisco up 14%. And Amphenol up a very strong 74%. Now I'm going to summarize some of the major AI themes. 1, hardware. We are still in the early stages of building out the entire AI infrastructure. On its recent quarterly conference call, Microsoft mentioned the explosion in growth in tokens. Now, what's a token? It's the data that is converted into what is called tokens. Think of it as units of information that AI models process. This explosion in tokens is taking computing demand to a whole other level. On that call, Microsoft said, quote, "We processed 100 trillion tokens this quarter, up 5 times versus last year," unquote. To process all this information, you need new data centers, all kinds of hardware, from NVIDIA chips to Broadcom custom chips, and to all the connecting technology needed to connect all these chips and servers together, to the companies that manage and operate these data centers as well. So here the winners are NVIDIA, Broadcom, Arista Networks, maybe Cisco, Amphenol, and CoreWeave, the data center manager that went public in March of this year. Theme 2, hyperscalers. Only large companies can afford to create the enormous cloud-based data centers where AI can be stored and the data analyzed. And that's Meta, Google, Amazon through AWS, Microsoft, and now Oracle, and of course, OpenAI. Number 3, software. The companies that can gather and analyze all of this data are going to be kings. That's Palantir and MongoDB and many others. And number 4, energy. Now I'm going to spend a bit of time on this one. The new data centers have insatiable needs for power. So much so that utilities cannot be relied on to supply it all. Also, don't forget that the Trump administration has taken away the Biden incentives to create solar and wind. So solar and wind would have been part of the story, but not right now. So where are the opportunities? First, gas turbines, and that's GE Vernova, GEV. There are only 2 large companies that even make gas turbines anymore, GEV and Siemens. Now, to understand how much demand there is for gas turbines, let's look at pricing. GEV does not disclose much about pricing, but in a call in March, the CEO of Nextera, the very large utility company, said that the cost of building a new gas-generated utility plant has tripled to $2,400 per kilowatt from $785 per kilowatt in 2022. That's quite a price increase. And because of the current demise of solar and wind, the need for more electricity is insatiable, and nuclear, therefore, is making a comeback. So for a traditional utility that is playing in nuclear, that would be Constellation Energy. And if you were looking for something riskier, but with potentially larger upside, I'll flag a very speculative stock company, Oklo, OKLO. It manufactures small nuclear reactors that recycle and use nuclear waste. Sounds awesome. But right now it has no revenue because its product is going through an approval process. If and when it gets approved, you should see data centers using its small reactors to power the data centers without the need to rely on utilities for electricity. Also, uranium companies like Cameco have experienced a resurgence. And another power-related stock is Quanta Services, which builds and services utility plants. Theme 5, industrials. Building the new data centers is a complicated enterprise. They need electrical components provided by an Eaton and special cooling facilities and devices provided by a Vertiv. Now, the list above and the themes above is just a partial list. It's not meant to be comprehensive, but to give you an idea of how far the AI theme is reaching, and if you are interested, where you should start looking. And then there are the unknowns. The unknowns are the companies we know next to nothing about. There are inventing uses for AI. As I pointed out before, the history of tech is that many of yesterday's leaders drop out and never return. So who are the losers or the companies at risk? Let's start with Apple. It is no accident that Apple is the only member of the Mag 7 that is only flat for the year. The company has no AI strategy, at least that we know of. As far as anyone can tell, it is not playing the game of investing tens or hundreds of billions to create its own AI large language model. And again, it probably does not have to. Apple has the largest installed base in the world, 2.4 billion people. Anyone trying to sell anything AI related to the consumer has to go through Apple. And now that Google has won its antitrust lawsuit, it can continue to pay Apple for search. Maybe Google will leapfrog the AI competition by paying Apple to use Google Gemini. But until there is clarity on Apple's AI strategy, I think the stock will continue to lag. And then there's traditional software. The current consensus is that AI is a threat to tech consultants and to traditional software companies. You just don't need to hire Gartner or Accenture as consultants as much if you can get the same answer by just asking ChatGPT. So Gartner is down 49% this year, and Accenture is down 32%. And with respect to software, the cost of creating software is declining because AI makes creating software much more efficient and less time-consuming. So everyone is worried that the moats around traditional software companies are just not so moaty anymore. This is certainly the current consensus, and it may be right. But the traditional companies like Salesforce and Adobe are working furiously to incorporate AI into their products. I would not count these companies out, not yet anyway. There may be a real investment opportunity here, but we need some clarity and we just don't have it yet. Now, if I was a tech analyst, I'd be spending some of my time trying to figure out which of the traditionalists are making real inroads into AI. But for now, the charts on these stocks look awful. Salesforce is down 27% this year, and Adobe is down 22%. Now I want to talk about the risk of recession. I raise the recession flag not because I think we are going to have one. At this point, I don't. But a recession would have a somewhat unique impact on tech this time. Don't forget that much of what is happening in AI is not even in the public markets. OpenAI, Anthropic, and a multitude of others are all private and keep raising capital in ever-increasing private rounds. Now, there's nothing wrong with that. But let's go back to Oracle's amazing results from last week. Oracle said that its remaining performance obligations, which is deferred revenue plus backlog, exploded to $455 billion, up 359% versus last year due to mega contracts with AI-related companies. All of this is related to Oracle's cloud infrastructure business. Now, after that call, some people started to dig into the numbers. And it looks like of the $455 billion in remaining performance obligations, OpenAI constitutes, get this, $300 billion. Now, as of September 2025, OpenAI has raised almost $60 billion in 11 rounds. In its last round, OpenAI was valued at $300 billion. Clearly, OpenAI does not have currently $300 billion in cash to spend on Oracle. Now, don't get me wrong. If the market stays like this, OpenAI will be able to raise that money. And so will most of the other private AI companies. My issue is that one thing I know about recessions is that when they occur, fear takes hold. And it takes hold everywhere. In a recession, it will be a lot harder for anyone to raise money. So a recession within the next 5 years would probably mean that Oracle would not make those juicy revenue projections it was so proud to make the other day. I'd also point out that this week, NVIDIA announced a $100 billion investment in OpenAI for data centers. So right now, OpenAI can raise whatever money it wants. I'd also point out that most people are focusing on the $350 billion of CapEx being spent by the few large hyperscalers. But we are now entering the second derivative and third derivatives where the baton is being handed to some other players like Saudi Arabia and the UAE. It's still early. But for now, the AI story marches on. Last week, CoreWeave, the AI data center operator, announced that NVIDIA, which is a shareholder of CoreWeave, had agreed to buy cloud services valued at $6.3 billion. NVIDIA said the agreement required NVIDIA to buy any excess capacity not used by its customers and guarantees AI computing capacity will be in place when needed to support startups and small to mid-sized companies. There is a Shenanigans-style side to the NVIDIA OpenAI deal and the NVIDIA CoreWeave deals. NVIDIA is now basically doing vendor financing. It is funding its customers to keep buying its chips. GE used to do that, and it did not always end well. So to sum it up, the AI story marches on, and the need for funding is insatiable. Recently, Morgan Stanley put out a report estimating the amounts that will be spent for data centers through 2028. And the figure they came up with was $2.9 trillion, with $1.4 trillion being funded with cash flow from hyperscalers, and the rest funded by ABS, CMBS, corporate debt, private credit, banks, VCs, and sovereigns. That's a lot of money. And the fact that half of it is coming from operating cash flow of large, famous companies is actually healthy for this story. But the new NVIDIA vendor financing makes the story less clean. And now for the mailbag. This is from Trey. Hi, Steve. I wanted to ask you a couple of questions about investing during a recession. I started investing about 7 years ago during one of the greatest bull runs in recent memory and have done moderately well during this period. However, as my unrealized gains continue to increase, I can't help but have doubts about how much longer the good times can last. My questions to you are as follows. 1. What is your approach to investing during a recession? Do you have certain companies or economic sectors that you choose to lean more heavily into during a downturn? And 2, what would you consider to be the biggest leading indicators of a recession? And when do you decide it is a good time to sell? Thanks so much. And he thanks me for the show. So with respect to the first question, my attitude has changed. Pre-Great Financial Crisis, I thought the entire system was at risk, and I told people to raise as much cash as they could. But today, I am confident in our financial system, so a recession would just be a plain old-fashioned one. So my advice would be to go through your portfolio and get rid of stocks that you are no longer confident for the long term, and check to see if you've got any thesis creep problems. And if you are really nervous, I would lighten up some of your less favorite stocks, but I would not liquidate. The taxes are prohibitive. And long term, I think the US economy is incredibly dynamic and will emerge from any temporary recession. As for the second question, I look at all the same indicators others do. Economic data, leading economic indicators, but I also look carefully at consumer credit data, and especially consumer data that comes from securitizations, because that credit data comes out monthly and is a real leading indicator of the health of the consumer. So summary for this whole week, I would say, is too little regulation and investing becomes like the Wild West or a Vegas casino where the odds are not in your favor. Too much regulation and the system stalls out and everyone loses. My role is to call it as I see it and help measure the odds. And that's the wrap. This last week, we dropped an incredible interview with Michael Ha, the managed care analyst at Baird. We spent the entire hour discussing the problems at United Healthcare, and some of those problems, I think, are actually scandalous. So check it out. And this Monday, we will drop an interview with Dan Ives, the tech analyst at Wedbush. Dan covers an incredible number of tech stocks, so we had a great broad conversation of the entire tech world. I hope you'll tune in. If you haven't already, please consider subscribing to our YouTube channel so you can receive these weekly wraps along with our podcast and the financial literacy masterclasses. Subscribing is the best way to help the channel, and we really greatly appreciate your support. Also, be sure to check out our website, realeismanplaybook.com. There you can easily access all our episodes, as well as the financial literacy masterclasses and other goodies as well. Check it out, and see you soon. This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.